Hi guys, welcome to my YouTube channel. Thank you so much for all the feedback on my first video that I did. I really appreciate all the comments, the likes, and the subscriptions that I've gotten this far. Thank you so much. I appreciate each and every one of you. So today's topic is about financial dependency, dealing with debt. As you can see, as I alluded to in my first video, the road to financial freedom is filled with various stages. And the first stage is financial dependency, where you're fully dependent on credit or debt. Today, I'll be discussing various topics. So I'll be dealing with debt, how to building a credit record, the difference between secured and unsecured debt, good and bad debt, tips when shopping for credit, options when in financial distress, getting out of debt, and how I manage to negotiate my interest on my home loan. Just a disclaimer again, I'm not a financial advisor. What I'll be sharing is what I've learned, and nothing in this document constitutes as financial advice. So last week I took a Twitter poll just to understand what is the highest interest that people have ever been charged on their debt. And I obviously shared my own story of how I was charged 18% on my credit card when prime interest was 9%. Some of the answers I got included 27% on clothing accounts, 18% on car finance, and 14% on home loans. So what determines the rate, the interest rate that you're charged on whatever debt you take out? It starts with building a credit record. So your credit record is based on how much credit you have, your repayment history, your age, your employment, because this indicates to potential lenders your ability to service debt based on your past performance and how likely you are to behave when paying future debt that you might take out. You can build your credit record through a credit card, a store card, even insurance premiums. I know a lot of people don't know that, but you can use your insurance premiums that you pay or your telephone account to build up your credit record. And this is one of the greatest ways that you can use to build your credit record if you don't want to get into debt, just to build up your credit profile. Now, credit bureaus rate your credit scores based on your repayment ability and your repayment profile in the past. And this then determines the credit score that they give you. Now, credit scores they vary from bureau to bureau, but the generic ones have highlighted in this slide. Usually your low score is between 300 to 579. A fair score is between 580 and 669. And a very good credit score is anything above 700. And remember, you're allowed one free credit report annually, which you can get just to check on your credit profile. So how do you build a credit record? So you can take out a clothing store. I know people take out clothing store or credit card or a loan just to build up their credit profile. So to start off with, you can start by taking out a small credit limit, and then increase it over time. But the whole idea is for you to get into the habit of getting credit and then paying it off as quick as you can. If you have a credit card, remember, if you have a small credit card limit, use less than the maximum. Use this and the maximum. Do not just pay the minimum, pay it off when you can. Make sure you settle it every 55 days, which is usually the interest-free days that banks usually give out. And it's within this period that you can use the credit card without being charged interest. Thereafter, you're charged. Pay your accounts on time. And if you cannot meet your repayments, please speak to the lender and make payment arrangements. It's always better to be proactive and call the lenders when you can't meet any repayments, as then they're aware of any defaults that may happen. And always learn to negotiate your interest at inception. Never just take the first interest that is given to you, because more than likely the first interest is not the best that you can be given. So just to recap, what is secured and unsecured debt? So there's definitely two types of debts, and it depends on whether it's backed by an asset or not. Secured debt is usually debt that is given, or borrowings that is given against an asset. So usually a home loan or a car, because it's backed by an asset. And this type of debt is usually cheaper. because it's backed by an asset. The bank can easily, should you default, the bank can easily come and take the asset, sell it and recuperate some of that debt. Whereas unsecured is usually more expensive because there's no asset to back this debt. So therefore the bank is basically taking a bit more risk on you because it's not backed by any asset, and therefore it's usually more expensive and it's considered a bit high risk in terms of the lenders, in the lender's eyes. So always know what what prime is. Currently it's 7%. When you're quoted on a product, always benchmark it against what prime is to determine, is it too high, is it too low, and that will give you sort of a ballpark figure to work with. Always benchmark your interest against prime. Check the South African Reserve Bank website just to check what prime is, so you can always benchmark. And you always have the right to renegotiate if your credit score is good. If you have got a good credit record, you can negotiate the interest being charged. You're in a better position to negotiate because they know you've got a good repayment profile. And never just pay the minimum on your unsecured debt. Try and pay a bit more than you can. The difference between good and bad debt: good debt is debt that you usually take out to progress. If you started a job and you need a car, you need that car to get to work. So that's good debt. Or home loan, you need to live somewhere. So home loan cars are considered a bit of good debt. Bad debt is debt you get because you cannot wait to have something. Impulse. Other thing is never co-sign a loan. I know when people default on a loan that you've co-signed, you are held responsible by the lender. You step in their shoes to repay the debt. So never co-sign a loan if you can, because you don't know how that person's repayment profile is like. So tips when shopping for credit: two things that make debt expensive: the tenure of the loan. The longer the term of the debt, the more expensive it becomes. The interest charged on the loan. The closer you are to prime, the cheaper the debt. The further away you are from prime, the more expensive the debt becomes. And I've just given on this slide an example of the difference between two home loans based on their tenure. The one on the left is 1 million rand home loan taken. The total repayment, the total years taken is 20 years, and at prime, you see that the total repayments is 1.8, and the total interest over the term of the loan is 860. Whereas the one on the right is the same home loan amount, but this time we've increased the tenure of the loan, which is 30 years, and as you can see, the interest paid is about 1.3. So just remember, the tenure of the loan has an impact on how much you pay over the life of the loan. A quick recap: never accept the first interest quoted. Always negotiate. Shop around if you have to. If your current bank is not giving you a favorable rate, shop around the other banks. You don't have to stick with one bank. Options when in financial distress. Now, I know COVID has had an impact on various people in terms of their debt and their ability to repay their debt. So just some of the options that are out there: debt restructuring or consolidation. This is where you take a various number of loans that you have, small loans, and consolidate them into one. The benefit of doing that is now you have one loan to repay, and usually, because when they restructure the debt, they increase the tenure of the loan, it reduces the monthly repayments that you have on particular debt, and now you only have to service one debt. But then the caveat with this debt restructuring is that you need to ensure that you change your behavior. In terms of debt review, usually people go under debt review to protect the assets from creditors, where they know that they're unable to pay, but they need a bit of time to ensure they restructure their facilities and are able to repay. There are a few cases that I know of where people have been able to come out of debt review. It's a long process. They restructure the debt, so therefore it takes a long. Your debt counselor sits down with you, takes you through the process, and goes to all the creditors and speaks on your behalf to make payment arrangements with the various lenders. If you are married in community of property, both parties enter into debt review, unfortunately. And unfortunately, one of the requirements is that you need to be employed to consider for debt review, because the debt review plan will show the way how you're going to repay the debt. You need to have an income to qualify for this, for debt review. It's always important when you're in financial distress to assess options available. At various stages of your financial journey, you will require debt. I mean, it's a stepping stone. It's a way to leverage your income to move higher. So getting a house, getting a car, but at the same time, make sure you always leave breathing room for yourself so that you don't go to the max of what you can afford. Never go for the maximum of what you can afford. Always try and go for less than what you can afford. Understand your behavior. What got you into debt? Is it trying to impress people? Is it, pouring from an empty cup, trying to help everyone but yourself? I know with Black Tax, when we get the first job, we want to help everyone around us. Understand the behavior that got you into debt in the first place, and then take action. What actions can you take to get out of debt? Be brave, have those honest conversations. And then the various debt repayment methods when you want to get out of debt is a snowball method. With this method, you start with the smallest debt, and once paid, you move to the next debt until your debt is repaid. While the debt stacking or the avalanche method is where you list all your debts and then start with the highest interest debt first, and then move on to the next until it's fully repaid. And set milestones for yourselves. By the end of the year, I should have paid off my credit card. By the end of the year, I should have been halfway towards paying my debt. And that way it keeps you accountable. I'm going to tell a story of how I managed to negotiate my interest on my home loan. I was 6 years into my home loan. I was paying prime at the time, and I was not happy with prime because I had been servicing my debt, my home loan repayments quite well. I had been paying extra into my bond. I played the loyalty card. I went to the bank and I told them I'd been a loyal customer for 7 years. I paid my monthly installments on the home loan via debit order, and I'd never missed a repayment. I called the home loans department and talked to a consultant about my account conduct and paying extra into my monthly installments. I spoke about how the value of the house had appreciated over time since I'd taken out the home loan. I asked for my interest on the home loan to be changed. We had that discussion. I sent all the necessary documents, and they came back to me and reduced my interest that I paid. I essentially got a reduction in the interest that I was paying. I went from paying prime to prime -2. So never be afraid. If you've been a good paying client, your credit record is good, never be afraid to call up the bank. Just to recap, we're on the road to financial freedom. We're trying to sort out our finances so that we can move from, being in debt to financial abundance. And once you've reached a place where your investment income is giving you enough money to cover your monthly expenses, then you've reached financial freedom or financial independence families. Thank you. And remember to subscribe, like, and comment.